Hi, and welcome to this session of Mind of the Manager with Foord Asset Management. I'm Linda Eads, and I'm joined today by Portfolio Manager Brian Arcees. And we're going to be talking about the global markets and giving you an inside look at the Foord Global Funds in particular. Now, we know that markets are very overwhelming right now, and there's seemingly no place to hide. Just about every single asset class is in negative territory over the year to date, and that's from emerging markets right through to developed markets. We've got rising inflation, rising interest rates, but also rising recession risks and geopolitical issues. So we do understand that it's a really tough backdrop for investors to make decisions. Now, our promise to you for this session is that you'll leave with a very clear idea of the themes that form part of our global outlook, that you'll understand how we're positioned, and that you'll be armed with good examples of the types of businesses that we consider attractive right now. And I'm going to tell you something that you probably didn't know about the state of New Hampshire, so listen out for that. Thank you to those of you that have submitted questions ahead of time. It's really helped us shape the conversation around the topics that are top of mind for you as investors. So we'll address those, some of those within the content of the presentation, but we'll also take some questions from the floor. So do use the Q&A box on your screen to type in some questions. I see that some have come through already. Now, we do tend to use a lot of financial jargon. We don't mean to, but we do apologize up front if you do find the discussion a bit overly technical. Please feel free to get in touch with our team to have a chat about your investments at any time if there's anything you don't understand. Also, please bear with us, as you already have done, with any disruption that we get from our friends at HCOM. We'll do our very best to keep the show on the road. Now, I'm a recent addition to the team here at Foord, so you may not know me yet, but I'm sure most of you already know Brian is a co-portfolio manager for both the Foord International Fund as well as the Foord Global Equity Fund. And we use both of those funds in all of our local multi-asset class funds as well. Now, Brian originally hails from the US, as you'll hear from his accent, but he is based in our Singapore office. And we actually start every single working day with a meeting which includes everyone from our global investment team. So all of us here in Cape Town and in Singapore, we get around the virtual table. And I must say it's an absolutely fascinating time to be managing funds. So thank you for the privilege of being able to do that for you. Now, Brian will talk to both of our global funds. As I say, we use these funds to implement our global views within our local funds. So that includes the Foord Conservative Fund, the Foord Balance Fund, the Foord Flexible Fund of Funds, as well as the Ned Group Stable Fund. So this is going to give you a very good sense of the global portion of those funds as well. Of course, you can invest directly into those funds. They are US dollar-based funds, but we have also recently reopened the feeder funds for both of those funds. So please chat to your contacts at Foord about how to go about accessing those. But just to briefly explain the difference between the two funds before we get into them, the Foord International Fund is actually our longest running global mandate. So it's a conservatively managed multi-asset class fund that seeks to both protect capital in market declines and generate returns of around 3 to 5% above inflation per year. So that fund can actually move between equities, bonds, cash, all the asset classes to give investors a less bumpy ride. Whereas the Global Equity Fund, as the name suggests, is a fully invested global equity fund. It's benchmarked against an equity index, and it's going to be invested in the equity markets throughout the market cycle. So it is going to be a lot more volatile than the Foord International Fund. Now, we're going to be speaking specifically to our global positioning today. We did get some questions on the local context. Understandably, there's a lot going on, but we will be holding another Mind of the Manager session in the next month or two, and that'll be very much centered around the local context. And we also have some very exciting developments with regards to new members of the team joining from that side. So please do keep your eyes open for an invitation to that session. Now, Foord manages roughly about $2.5 billion in global assets. And actually, our firm's global track record goes back more than 25 years. Of course, you'll know that Foord has actually been around for more than 40 years, but we have been managing global mandates as well for 25 years, just over that, in fact. And I think that's very important to bear in mind, because if you think about that time frame, it includes many different market backdrops, and we've come out of just over a decade of incredibly low interest rates, easy money, excessive stimulus, and off the back of all of that, pretty much consistent bull markets up until very recently, of course. And I think some of the younger members of the audience may actually have only had that as the backdrop for the majority of their careers up until recently. But we're going into a different market phase now, and I think that's very important to bear in mind. So at least you can trust that Foord does have a team that has successfully navigated many different parts of the market cycle through many different market circumstances. Now, if you've been following Foord and our strategy, you'll know that 2022 has ushered in an investment landscape that the team has been talking about and has actually been positioned for quite some time. And whilst this served the portfolio as well in 2020, when we did see some market declines, it did cause significant underperformance during 2021, which is of course difficult for all of our investors. Now, the tricky thing about managing risk is that just because risk didn't materialize doesn't mean that the risk wasn't there. So for me, it's a bit like putting your seatbelt on when you drive your car. You know, just because you didn't have an accident doesn't mean that there wasn't a risk of having one, and it doesn't mean that you should therefore not wear your seatbelt as a result. And in fact, we know now that wearing your seatbelt actually reduces your chance of dying in an accident by more than 50%, and also more than half of the people that actually die in car accidents weren't wearing their seatbelts. Now, I went traveling around America after university, and when I was in New Hampshire, I was actually very surprised to learn that that is the only state in America which doesn't require adults to wear a seatbelt by law. And in fact, on their number plates, they have the state motto, which is live free or die. Now, Foord has spoken quite often about having safety first as something of a motto in terms of how we manage your money. But I think conversely, live free or die is not an inaccurate way to describe a lot of the investing that we actually saw in 2021. And if you think about the mania that surrounded cryptocurrencies, the rise of day trading, NFTs, SPACs, I think many investors were investing without considering the risks on the horizon. And at the time, the risks were also being glossed over by the market. But as we've seen more recently, it doesn't mean that the risks weren't there. And personally, I know which motto I'd prefer for the stewardship of my own capital. And certainly over the year to date, having a safety first strategy has started to bear fruit, and Brian's going to talk about that. But of course, protecting capital is only one part of generating inflation-beating returns. We also have to allocate investments which are actually going to provide upside over time. So Brian's also going to speak to you about the key investment themes that we see playing out, how we positioned across geographies, across asset classes, sectors, and indeed in the types of businesses that will serve the dual purpose of both protecting and growing your capital against a backdrop of rising risks. Now, after Brian's presentation, I'm going to put to him some of the questions which you've kindly submitted to us, and I'm going to have a look at what's come through. So I'm going to enjoy this very short window of opportunity while I'm new, where I get to ask the questions before I have to start answering to them. So with that, I'm going to hand over to you, Brian.
Thank you, Linda. As Linda mentioned, hi everyone, I'm Brian Arcese, multi-counselor portfolio manager on the Foord International Fund and the Foord Global Equity Fund here at Foord in Singapore. Well, I'm excited to join you today. I'm more excited that the prospect of us meeting again in person for our next conversation is looking ever more likely. Today, I'd like to briefly cover 4 items. First, our macro thoughts in what is certainly a volatile environment. Second, 2 key themes that are currently active in the portfolios. Third, portfolio positioning across asset classes, regions, and sectors. And finally, investment performance. And following, as Linda mentioned, we plan to leave a lot of room for discussion and questions, which Linda will facilitate. Before I run through the agenda, I did want to highlight and reflect briefly upon our flagship multi-asset Foord International Fund, celebrating its 25th anniversary in this current quarter. Any milestone is cause for reflection, and having managed our international fund for a quarter century, there are no shortage of items to reflect upon. On the screen is a graph that accompanied an article I wrote to commemorate the 20th anniversary of the fund 5 years ago. We further extended the graph to present day. The article then aims to unpack the performance of the International Fund through the lens of the investment cycle. While our objective has always been focused squarely on protecting capital and delivering inflation-beating real returns, many investors had begun to expect equity-like returns even during periods of rapidly rising equity markets. While focused on highlighting the fund's solid history of protecting capital in down markets and through cycle performance that had handily bested inflation, peers, and even equity markets, investors had begun to wonder and openly inquire as to whether the fund had lost relevance 8 years into what has become the longest post-war economic cycle. I concluded that piece 5 years ago with the following paragraph. As we near the end of this investment cycle, it is our expectation that the fund will again provide investors with the same degree of protection afforded during the first 2 full investment cycles of its existence. When this third investment cycle is complete, we expect the fund's relative returns to more closely mirror historical patterns. Sitting here today, 5 years on, this statement has borne fruit as the fund meaningfully protected investor capital in the 2 most recent market drawdowns. Firstly, at the onset of the pandemic during the first quarter of 2020, markets reacted harshly, declining 34% during the period. While the fund declined 18%, the drawdown was far less severe than that seen in global markets. Secondly, performance during this current year, which obviously includes Russia's invasion of Ukraine and the liftoff of the US federal funds rate, was strong, with the fund declining 1% through Friday versus a market decline of 20%. While the current investment cycle has not yet concluded, it is clear from the graph shown that the recent and market declines posted in equities, bonds, and by our peer group has not impacted returns in the International Fund. We've always highlighted that it is during these periods of market drawdown and increased volatility that an investment in the Foord International Fund will show its worth. And we're pleased to be demonstrating that so clearly now. Before walking through 2 key investment themes being expressed across our global portfolios, I wanted to give a brief overview of how we see the current macro environment. Having first discussed the prospects for accelerating inflation at a webinar more than 2 years ago, we continue to believe inflation to be more structural than transitory, or at least a minimum for the transitory period of higher inflation to last longer than investors currently expect. There are a number of contributors to these inflationary tailwinds, including the following. Underinvestment in traditional energy resources has and will continue to result in a supply crunch for many years before renewable generation accounts for a sufficient proportion of supply. Global supplies of many industrial metals, including copper and several rare earths required to further the energy transition, are currently not sufficient enough to meet requirements. Agricultural inflation, though currently experienced acutely as a result of Russia's invasion of Ukraine, together these countries account for more than 1/3 of global wheat production. It will remain elevated as countries globally are forced to rethink food security and start to produce at least a portion of their required food intake at home, regardless of the increased cost. Though we hope for a peaceful resolution of the current conflict in Ukraine, regardless of outcome, the countries that previously weren't convinced of the necessity to onshore a portion of strategic materials, including semiconductors, for example, certainly are now. Even if only a portion of a country's semiconductor demand is onshored in the coming years, this will add to inflationary pressures. Finally, corporate margins remain at record highs, a plain-to-see demonstration of the fact that profits have flowed disproportionately to the owners of capital rather than labor. The reversal of this trend, already evident in many parts of the world, will continue to put pressure on wages in the upward direction, and that pressure will remain and most likely increase. Though behind the curve, global central banks have and will continue to be hawkish in their endeavor to stop inflation expectations from gaining or establishing a firm foothold in the consumer psyche. The probability of over-tightening is certainly far greater than 0. Third, though not yet reflected in consensus analyst estimates, earnings growth rates are and will continue to moderate. We expect earnings to be increasingly challenged in the coming quarters. Fourth, for reasons other than inflation protection, of which it has historically been little correlated, we continue to believe gold will maintain its safe haven appeal. The metal serves as a solid hedge during periods of volatility, whether market or geopolitically driven, and has posted some of the best asset class returns year to date on a relative basis, despite the headwind of rising real interest rates. Finally, select Asian countries and markets are attractive relative to many developed market peers. Of note, select equities and companies in China, despite being saddled with operating in an economy running far below capacity due to COVID restrictions, they're trading at valuations far less than their intrinsic value. The theme I'd like to highlight first is the fund's materials exposure. We have sizable commodity exposures across our portfolios, which includes participants in the agricultural commodity value chain, precious metals, streaming businesses, oil and gas players, and industrial miners of copper and lithium. It's worth noting that these positions have each been held for several years and are rooted in strong bottom-up fundamentals for each. Individual businesses that we own see tremendous long-term value on their own. They just happen to be in more cyclical, commodity-focused end markets. Given the cyclical nature of these materials businesses relative to our technology or consumer-focused holdings, for example, we do focus more effort on gaining comfort around the macro cycle. It's important to note, however, that the cycle is not essential for these securities to perform well. If anything, the tailwind of inflation and supply chain disruptions in these markets serves to bolster an already compelling opportunity. For example, if we look at our holding in Pan American Silver, the company will generate its entire market cap in cash in 7 to 10 years' time at spot commodity prices, with little to no help needed from the cycle. It's the same with a copper producer like Freeport-McMoRan or an energy business like Total, where long-term supply is meaningfully constrained for various structural reasons. The copper mining sector in particular has been starved of capital investment over the past 5 to 7 years, and this is just as demand for copper is set to ramp with new demand for renewable energy applications. So even though we don't need strong commodity prices for these securities to work, the underlying long-term demand-supply dynamics are heavily skewed to the upside. Some of our agricultural-focused names, like Nutrien, FMC, or Corteva, are underpinned by strong idiosyncratic structural drivers. Nutrien, for example, operates the largest ag retail network globally, similar to a Home Depot for builders or Sherwin-Williams for painters. While FMC and Corteva are among the highest quality seed and ag chemicals providers that contribute to enhancing farmer economics, and this is irrespective of the commodity price environment. All these businesses are among the lowest cost producers in their particular markets. They have almost no debt, have best-in-class management teams, and are razor-focused on capital allocation. Taken together, these commodity names represent approximately 1/5 of our fund's exposures and allow for nice diversification across our global portfolios. The second theme I wanted to highlight this morning was one revolving around Asia, and in particular, Asia's middle-class consumer. The graph on your screen shows the share of middle-class consumers located in each of the major geographic regions around the world. The red bars represent that breakdown 10 years ago. The light blue bars present day, and the dark blue bars less than a decade from now. The most important takeaway to glean from this graph is the rapid shift in location of the world's middle class. Only 10 years ago, 70% of the global middle class was in Europe and North America. And only 8 years from now, 70% of the world's middle class will hail from Asia. I do want to highlight, as I received questions about this previously, the middle-class population in Europe and North America isn't necessarily declining, but the percentage shifting to Asia is entirely a function of outsized growth within the region. Most countries in Asia are rapidly expanding their middle class, not least of which are China and India, and we have at times invested in both. Additionally, we've held positions in companies domiciled in Singapore, Thailand, Hong Kong, and Cambodia, for example. On the right-hand side of this slide, you'll see the names of a handful of companies currently owned in the portfolio that each in their own way benefit from an expanding consumer market. In the interest of time, I'll highlight 2. First, JD.com is a market leader in online retailing, and as importantly, has built one of the strongest logistics and delivery networks in all of China. Concerns have weighed on shares in part due to regulatory challenges focused more on the technology sector than on JD specifically, and second, due to China's current COVID-0 policy. Now, I do anticipate questions relating to the Chinese tech regulatory overhang, and in the interest of time, I'll save my comments for the discussion period. In regards to COVID headwinds, JD has a very strong balance sheet, over $20 billion of cash to withstand additional COVID-related disruptions. More importantly, JD is a key government partner in fulfilling consumer daily necessity needs during lockdowns. For example, during the recent Shanghai lockdowns, they diverted significant manpower from other provinces to support e-commerce logistics requirements in Shanghai. Historically, we've seen substantial growth in e-commerce demand post-initial periods of lockdown. JD should also see similar strength as the logistics bottlenecks get resolved in cities across China. And second is AIA. For those unfamiliar, AIA is a global personal and casualty insurer selling everything from critical illness, personal accident, disability, and medical insurance. Now, there's a demonstrable link globally to increases in per capita income and the purchase of insurance products. First, families work to attain and maintain a minimal standard of living, and then once attained, they aim to protect themselves in the event of unforeseen illness or disability, as well as protecting their families. AIA is well positioned to take advantage of the growth in insurance penetration. Some of you may have seen this graph previously, though I wanted to share it again as it highlights one of the reasons we believe investing in Chinese shares provides a compelling opportunity. China remains significantly underrepresented in global investment indices. What this slide depicts are the relative sizes of the US and Chinese economies. While the US is 50% larger in GDP, when looking at GDP from a purchasing power standpoint, purchasing power parity, the Chinese economy has already eclipsed that of the US. As you can see here, the US accounts for a quarter of global GDP, but garners a 60% weighting in the MSCI All-Country World Index, the most widely used global equity benchmark. While China represents 18% of global GDP, it garners only a 3% share in that same benchmark. Additionally, for similar levels of earnings growth, in fact, China growing earnings slightly more quickly than the US, Chinese shares as a whole trade at nearly a 50% discount to US shares. Now, obviously, we aren't buying indices, we're investing in companies, but even when narrowing that scope and looking at individual companies that are of high quality, there are a number of firms trading at substantial discounts to their global peers and offering attractive relative risk rewards. Now, moving on to positioning, I'll highlight our current asset allocation as of the end of May 2022. As seen here on this graph, the lion's share of our multi-asset portfolio is invested in equities. The 57% equity allocation shown here represents our net equity exposure, which is a combination of a mid 70% weighting to equities on a gross basis, hedged down to 57%, using short futures and options positions. Commodities and materials are the second largest exposure within the fund. The 7% shown on this slide largely represents our gold position, which I spoke about earlier. The 7%, however, underrepresents the fund's actual commodities exposure, as a full 16% of our equity exposure is held in securities that are commodity linked. In total, the fund's commodities exposure is closer to 23%. Having been absent both corporate and sovereign credit for large periods of time due to what we believed were interest rates far below what should be required to compensate investors for the accompanying risks that they're taking, rates at the short end have now risen to a level where we're comfortable holding these short duration credits. Our current positions include the US 2-year, as well as 2 recently purchased corporate credits. Additionally, we hold a mid-single-digit position in property. It's a Hong Kong-listed developer and operator of A-class malls. Finally, the fund's cash position sits at 27%, which includes a high single-digit cash balance in cash itself, plus an additional high teens percentage of cash generated by our short futures positions. Cash is held to take advantage of what will likely be continued volatility, both in equity and in credit markets. The fund's positioning by region and sector is shown on this slide. While our exposure to North America appears materially higher than other regions, this includes our cash balance in the multi-asset fund, which is held in US dollars. Within equities, we are finding opportunities across the US, Europe, and Asia. Our exposure by sector, seen on the bottom, is unlikely to be a surprise given the 2 themes I've just discussed. The fund's largest exposures by sector are to the materials and consumer sectors, including communication services. Finally, I want to briefly touch on short-term performance through what has been a volatile year. On the left-hand side of this slide, we're showing the performance of our Foord Global Equity Fund, both against the benchmark, the MSCI All Country World, and within the peer group. Year to date through last Friday, the fund is outperforming the benchmark by 4.3% and sits solidly in the top decile of global equity funds. While those who have followed us for some time know that our medium performance in our global equity fund has been challenged, largely due to our exposure to Chinese equities, it's becoming ever more apparent that the regulatory overhang recently impacting Chinese shares is beginning to abate, and we're pleased with our year-to-date rebound. On the right-hand side, we're showing the performance of our multi-asset Foord International Fund, having declined 1.2% against a market down 20% this year, again sitting solidly in the top decile of peer funds. I'm pleased to highlight that our performance in this market drawdown has resulted in us adding an additional star to our 3-year Morningstar rating, with the fund now rated 5 stars. Again, for long-term followers of our international fund, you'll know our long-term performance is also strong, with the fund rated 4 stars and ahead of the benchmark and peer group over all time periods. Thank you, and now I'll turn the conversation over to Linda, who will moderate the rest of the discussion.
Thank you, Brian. Let's move to some of our investors' questions. Before we actually get into the extent of the investment side, I just wanted to answer a brief question on our feeder funds. They will be open to new investors, and that is because we are going to be opening them on the prescient Manco. So please do speak again to your contacts at Foord about how to access those, and of course also encouraging the platform providers to put those feeder funds onto their platforms so that you can use those for new investors as well. So Brian, let's talk about sort of the difference between what happens in the markets, what is expected, what we expect, and taking advantage of the difference. Because of course, the question is, to what extent have global markets already priced in the interest rate increases that we spoke about in the US? And that comes from Christo. To what extent do we believe that markets have priced in the increases that we anticipate, given that we believe that central banks will continue to remain hawkish?
Sure. No, that's a great question. So I guess I'll answer it in 2 ways, both on the credit side and on the equity side. If we look at from a futures standpoint in the credit side, certainly in treasuries, the market seems to be pricing in on a forward basis a terminal Fed funds rate of somewhere between 3.75% and 4%. Now, as we've mentioned many times, we deal in probabilities and not in binary bets. So our own expectations, we're not spot forecasting a terminal Fed funds rate at a specific point in time. But if we look at the probability of a Fed funds rate terminally being above 3, certainly our expectations with that would be very high. If we move to 3.5, it's a reasonable probability, even in our expectations. As we get closer to 4, it's also within our range of expectations, but at the smaller end of the range. And that's why we started buying short duration credit as the market started to price a 4% terminal Fed funds rate. Now, I will say that the market pricing interest rates is very different than the credit market pricing credit risk itself, which in our mind, the market has yet to do. So we don't think the market, particularly in high yield, is accurately pricing credit risk going forward. So we aren't active in that space. On the equity side, if we look at returns, sort of the NASDAQ from peak to trough, about 30%, the S&P 20. But if we look kind of more deeply at the NASDAQ or unprofitable tech or unprofitable and growth biotech, those markets are down 60%. So in that space, I do think that it's starting to price in rate expectations 4% or even higher. These are drawdowns that are greater than what was experienced during the tech bubble bursting, for example. But what we have today are companies that are actually growing revenues, which certainly wasn't happening at all during the tech bubble bursting. So we aren't rushing wholeheartedly into equities. I mean, we covered what our asset class allocations are at the moment, but some markets are slowly starting to price in these increases in interest rates that are likely to come.
Thank you, and I hope, Edward, that answers your question about whether the Fed is likely to achieve the 2% inflation target by the end of 2023. We don't expect that to be the case, and that is, of course, why we're positioned away from those parts of the market. But speaking to the areas of the market that we do have exposure to, Brian, you spoke quite a bit about our exposure to Asian equities. And I just wanted to clarify, I think sometimes, there's a misperception that our funds are majority Asian equities or majority Chinese equities. Obviously, that is a part of the market that we think is very attractive for the reasons that you mentioned. But just to give some context, can you just clarify what the percentage of total roughly is of the funds that is exposed to Chinese equities in particular?
Sure. No, it's a great question. So in the international fund, the multi-asset class fund, about 15% of the fund is exposed to Chinese or Asian equities. So obviously 85% is invested in other markets. For the global equity fund, it's about a quarter of the fund that's invested in Chinese equities or equities that are linked to Chinese consumer demand growth.
And following on from that, Davey would like to know sort of how we think about the political and regulatory risk and how we actually value our exposure to China. And there he notes two specific risks which come to mind. The first is China invading Taiwan, and perhaps as a result of one, his second risk that he talks about is US sanctions China on human rights abuses. How do we actually sort of factor in the regulatory risk and I guess also some of the geopolitical risk when we actually look at these companies that we wish to invest in?
No, that's a great question. And I think it really comes down to kind of what we do as our hallmark, which we say is managing risk and finding value. So as I've mentioned even earlier in this webinar, we don't take binary bets. So despite the fact that Chinese equities are trading at a 50% discount to US equities, for example, despite the fact that earnings are growing more quickly, in our conservative multi-asset class fund, they're only 15% of the portfolio. In our global equity fund, they're only a quarter of the portfolio. So we do manage by position sizing. Now, if we thought the risks were increasing, either from a regulatory standpoint or a geopolitical standpoint, then certainly we would reduce that weight even further. But we're comfortable with the weighting as it sits today, particularly in the context of the entire portfolio.
And so you've spoken about the exposure in Asia. We've also had some example of materials. And I think the important thing to mention there is that materials, when we think of materials in South Africa, we think of sort of mining companies. And I think you spoke about sort of a much wider exposure to various materials in the fund. But you do have some exposure in North America. As you mentioned, it isn't a huge exposure because some of that exposure in the graph is cash. But what opportunities are you still finding in the US markets, given that they are quite expensive still at the overall level?
No, that's a great question. So in the US in particular, I mean, if you were to look at our sector allocation kind of as a subset of that regional allocation, we obviously had materials and consumer, but another large sector allocation we have is to healthcare. So two of the names in that healthcare opportunity set is massive globally, but in particular in the US. So two names that I would highlight. One is UNH, which is the largest managed care provider, so medical insurance provider in the US. It's 475 billion market cap, so it's massive. But despite that, and the company's focus on really driving costs out of the US healthcare system, where everyone, even globally, knows how expensive it is to receive care in the US, enables the company to continue to grow earnings even from its current size at mid-teens to 20% rates. So that is an example of a company that we're finding attractive in the US. And in the same sector, we own a company by the name of BioLife Solutions, which is 600 million market cap. So it's dwarfed by UNH. But what BioLife does, it plays in new life sciences. So all of the new gene therapies that are produced, a significant portion of them use BioLife Solutions, so their actual solution, as a medium for these gene therapies to live in as they're transported from a manufacturing site to the patient. So that's also a company that we have a lot of conviction in. So the opportunity set is, it's quite big across regions and across sectors.
And then sort of moving away from the developed markets, Daniel has actually asked us about whether we think emerging markets as a whole offer an attractive opportunity set. Obviously, we do have exposure to Asian emerging markets, but he wishes to know, are we taking exposure in other parts of emerging markets, or is that pretty much limited to our Asian emerging market exposure, which you've already spoken to?
Yeah, so our emerging market exposure at the moment is limited to Asia, but it's really a function of where we're finding the most attractive opportunity set from a company standpoint and a country backdrop. But everything for us really boils down to the fundamentals of the individual security, more so than making a macro call of moving into emerging markets broadly or out of emerging markets broadly. There are a number of emerging markets here in Asia that are net importers, for example, of energy or of food. And as we chatted about inflation earlier, those markets, such as the Philippines, might be materially challenged as prices continue to rise. So we wouldn't necessarily say investors should move completely into emerging markets, but it's rather kind of pick the individual companies where the risk reward is attractive.
That makes sense. And Jonathan has actually asked a very interesting question about the landscape that we're looking at currently relative to the 2008 market crash. And he wants to know what asset classes, if you could remind him, provided positive returns or were the safe havens during that time. And then also just following on from that, what do you think are the similarities and the differences between what we're looking at now and what we had in 2008?
Sure. No, it's a great question. I'm quite happy to say that I think there are many more differences than similarities. We don't want to live through that again. The asset classes that performed best in 2008 were primarily credit. So global credit, even high yield credit for a portion of the time, all provided positive returns. But if we rewind to 2008, it's really a function of starting period as well. So the US 10-year going into the global financial crisis was around a 5% yield. If we look today, we started, only 18 months ago, the US 10-year was at 50 basis points. Back then, inflation was averaging about 3%. Today, at the moment, we certainly expect inflation to abate from the high levels it's running at currently, but it's currently at 8.99%. So the corollaries in what asset classes are likely to perform well in the current environment, they don't necessarily hold. We don't think that credit is the place to be, certainly long duration credit at the moment. And that's why our asset allocation kind of leads us into commodities as an inflation hedge, but as I mentioned, also in securities that will do well regardless of the cycle, in select equities, in short duration credit, in cash to be opportunistic, and then in gold.
And so you spoke a little bit about credit, and Stuart actually wants to know, it is a bit of a confusing time to be looking at bonds as an asset class. Are they a safe place to hide during current volatility, given rising interest rates globally? And of course, as interest rates rise, the yields become much more attractive. Or are they actually a bad place to be, given the rising inflation outlook? We know that inflation is, of course, terrible for bonds. How do investors sort of weigh those things up? And at what point does one sort of dominate the other in terms of whether bonds would be the right place to be allocating more capital to? Brian, what would you be looking for there?
Sure. So I guess I would answer it in a few ways. We don't really, in the face of high inflation, if you're going to hold a fixed credit through to maturity, it's not really a great place to be. You may be locking in a negative real return. Obviously, that's a simplistic way to look at it, but in general, I think it's a reasonable way. We prefer to hold cash and be more opportunistic and take advantage of volatility in the equity market, as an example. Now, that being said, on a 2-year view, the shorter you go out on the curve, you can get more comfort, both from a credit standpoint and an inflation standpoint. So as kind of the short-term rates approach kind of 4%, even the US 2-year not that long ago, mid-month, was at 3.5%. So relative to cash, that's attractive. And so we kind of look at it that way. We'd much prefer to own cash and equities than long duration bonds. But we do think the short end of the curve is starting to look attractive.
And then Jean-Paul and Sahil, they've both actually raised the geopolitical risk issue. You've spoken a little bit about some of those risks and how we manage them from a portfolio construction perspective and sort of looking at each specific business. But they also ask, with regards to the Russia-Ukraine situation, which has obviously been something that's come onto the horizon, has it changed sort of what we've invested in terms of our portfolio? Have we increased or decreased exposure to any parts of the market as a result of that rising geopolitical tension?
No, we haven't, and I think that's really just a testament to kind of how we manage risk and manage the portfolios in general. I mean, we didn't have any exposure to Russia or Ukraine, both directly or really indirectly. So that event in and of itself, obviously it impacts other securities in the portfolio and it impacts global inflation and many other things, but directly we didn't have exposure. We haven't reduced exposure in other emerging markets, for example, because we always, in our minds, kind of take a measured approach. So, I mean, the risk of China invading Taiwan, for example, it was there before Russia invaded Ukraine. It remains there today. We can manage it by position sizing. And as rhetoric increases, we may decide to reduce our position in China. But as I mentioned earlier, we're comfortable with our position today. And I kind of think at risk, I mean, geopolitical risk is a big one, but to us, it's also one of many risks at the individual company level, at the country level, at the market level. And if we kind of rewind kind of 15 or 20 years ago, I mean, two of the largest corporate frauds, Enron and WorldCom, both took place in the US, which are developed markets. And so I think that's a reminder to us as well that there's really risk everywhere, and you need to manage it through portfolio construction as much as anything else.
Absolutely. And now Spalding has asked a question which I think sort of speaks to whether we believe we can achieve our investment objectives given the way that we manage money. His question specifically is, would you mind reflecting on the investment style and the appropriateness of our investment style in current rising interest rates and the fundamental analysis illustrating the upside value from current holdings? I think another way of asking that, Brian, is do we believe that the absolute return objective, for instance, for the Foord International Fund, which is 3 to 5% above inflation, is achievable given this backdrop, the way that we manage money over the next 3 to 5 years? What would be your answer to that?
Yes, no, it's a fantastic question. I mean, the short answer is certainly yes. But the reason, so I mean, you can tell by how we've positioned the portfolio currently. Our goal is to achieve this 3 to 5% real return through the cycle, which we have been able to achieve over the past 25 years. We aren't aiming to achieve it each and every quarter or each and every year. So we're not stretching to get 9% plus 4 in a market that's down 20. The risk required to generate that level of return in a year like 2022 is far too high for us to put in the portfolio. And that really isn't the intent. But our expectation is for inflation to remain higher, but certainly to abate and come off this sort of 9% level as we start lapping more difficult comps in the second half of this year. But from an opportunity set standpoint, I mean, the expected returns on a real basis in many of the Chinese holdings that we have in the portfolio, in many of our healthcare holdings or biotech holdings that I chatted about, are certainly high enough that through the cycle, we would expect the International Fund to achieve those inflation plus 3 to 5% returns. Absolutely.
Now, Andre has also asked something sort of with regards to how to generate returns over the next kind of market cycle. He sort of mentions that it seems we've now entered a buying market. I guess that's a question. But are US stocks, and here he specifically mentions the S&P 500, becoming more attractive to buy over the next 2 years? And Brian, I think it might be worth just chatting again about the hedge that we're using in the fund, in the Foord International Funds, to actually reduce our exposure to the overall market and why we've done that and how we've actually sort of dynamically changed that over time, and at what point do you think we would actually reduce that?
So that's a great question. I think if the question is, will the S&P 500 or US equities be attractive over the next couple of years, I think probably yes. Whether they're attractive now is a different story. So the way that we think about it, I mean, the S&P generally has sold off about 20%. And again, as I highlighted earlier, we can't always think in indices because we're investing in underlying companies themselves. But if we look at the market, it's sold off 20%. So optically, it's less expensive. Interestingly, we haven't seen earnings revisions come down at all. In many instances, they continue to be revised up. So I think that the market relative to where it was kind of 6 months ago is probably looking more optically cheaper than it really is. So it is more expensive on a real basis, and we do expect earnings revisions to start to come down. Now, in regards to how we manage the portfolio, because obviously markets are dynamic, and this is sort of gets to our asset allocation that I chatted about earlier. On a gross basis, we have 75% of the portfolio invested in equities, but we do use short futures and options to hedge that out. So it's very inexpensive, it's very easy, and we can also remove that hedge as easily and inexpensively as well. So if we do see attractive opportunities or the market as a whole attractive, it's not as if we have to go out and research sort of another 20% of the portfolio and add new holdings. We can simply remove the hedge and our equity weight would be back at 75% relatively instantaneously.
Okay, and then of course a very difficult question. I feel a bit unfair asking you this question, but I think it is one that is on investors' minds, is for those investors who are sitting with cash or who have clients who are sitting with cash, considering whether and when to invest, what comfort can you give them to encourage them to invest in the market at this point in time?
No, it's also a good question, and I do think a fair one. I would answer a couple of ways. I mean, one, obviously, we're long-term investors. I wouldn't encourage anyone to invest unless they had a 3 to 5 year horizon or even longer. So that being the case, it's a fine time to invest in the market. When people ask about kind of our own asset allocation, and I highlight how dynamic it is. I mean, if we look back to the beginning of 2020, for example, we had 80% of the portfolio invested in equities. By the end of the first quarter, on a hedged basis, that was down to 35%. Closer to the market bottom, only a quarter later, it was back up to 75%. And it was close to 75 at the beginning of this year. And at points in time this year has been down to 50. So it's not possible for a typical retail investor to do that in their own portfolio, nor should they try. But investing in a fund, in a multi-asset class fund that is doing that for you, you will get the benefit of that asset allocation through time. So it's certainly a fine time to invest in both global equity and in the international fund, particularly when taken together.
Thanks, Brian. And then just if in terms of the actual details with regards to the hedge, because I think that's a very interesting way in which we can actually dial up or dial down our risk to the markets depending on sort of where we see the cycle playing out. And it's a very, very effective tool that we have been using in our funds. Peter just wants to know, what does it cost to add hedging and how long does it take to remove them? Can it be done instantaneously? I think you spoke to that, but maybe it is just worth explaining again, because some of these concepts are not sort of things that we talk about on a daily basis. Just to elaborate a little bit more on that for us, please.
Sure. So the cost of hedging does vary if you're doing it using the futures market or if you're doing it with options. So options, it can cost anywhere from 25 basis points to 50 basis points, or even a couple of percent of the portion of the portfolio that you're hedging. So we do use that more sparingly. Futures, however, are very inexpensive. I mean, you're basically paying an interest on the amount, but where interest rates are, bank interest rates are, even today, having risen, it's quite small. And you're obviously paying commission on the individual's futures positions that you are buying or selling, which is also quite small. And in regards to the timing of putting on or taking out futures positions, in the futures market, in particular for the S&P, which is primarily where we do our hedging, is incredibly liquid. So, I mean, you can hedge, you'd be able to hedge billions of dollars. So if not near instantaneously, very close to instantaneously. It would only take a few minutes to put on a hedge for the full portfolio or take it back off.
Great. Well, unfortunately, that's all the questions that we have time for today. Thank you, Brian, for joining us. I'm just going to give a quick summary before we wrap up.
Thank you.
So to summarize what Brian has outlined, we continue to believe that inflation will be far more structural than transitory. We believe as a result that central banks will remain hawkish. We believe that the earnings growth rates will begin to moderate. And importantly, that this hasn't yet been fully factored into consensus analyst forecasts. So we do think that there is still some risk there. We still favor equities nonetheless over bonds and cash, but we have started to introduce some shorter dated credit in the portfolios, as Brian mentioned. We prefer equities with pricing power, businesses that are capital light with little to no gearing. We do still like gold as a diversifier, and that's not only as a hedge against inflation, but it also serves as an important hedge against the geopolitical risk that we spoke about earlier. We continue to have a relatively low allocation, in particular relative to how much of the index those parts of the market are to the most expensive parts of the US market. And we're actually more excited about similar businesses in communication services and tech that are based outside of the US market and therefore are priced a lot more attractively as a result. And we think that any forward-looking investor should be thinking about these businesses which still provide considerable opportunity and are changing the world around us. But we think very carefully about the price that we pay for those businesses. We do have select exposure to businesses in the materials sector. For example, we do have participants in the agricultural commodity value chains, precious metals streaming businesses, oil and gas players, and of course copper and lithium mines as well. And I think very importantly, some questions came through on the commodity cycle. These investments are based on the fundamentals of the underlying investments themselves, and they're not predicated on the commodity cycle continuing to remain in upswing. Of course, if it does, that will only benefit these businesses, but the fundamentals of these businesses stand alone and aside from that. We do remain concerned about the risk of the most expensive and largest businesses that still dominate the S&P, given their sensitivity in particular to US long bond yields. So we still continue to protect capital against that downside risk using a short S&P futures position, which, as Brian explained, is very easy and quick to unwind as we see those risks reduce on the horizon. So to summarize, Brian started this presentation showing you the multiple market cycles during which we've managed the Foord International Fund. And as he discussed, this cycle has been extraordinarily long in comparison to previous cycles, but it's also playing out exactly as we have been expecting. And this has taken some time, so thank you very much for your patience. But please know that you are in safe hands. Our team is very well prepared for this environment, and we do also have the experience of managing money through multiple market cycles to guide our decision making. Thank you everyone for spending this hour with us. I hope you found it a productive use of your time. There is a survey that's going to pop up on your screen when you exit. Please do give us some feedback. We really want to make these sessions as productive as possible for you. We will be doing another session on our local funds, so we'll save your local questions for that. Thank you very much for your time and take care.